I think gold is first supports around 3,000. I don't think it stays much below that. The paradigm shift that's happening in the market of just a little bit more deflation finally accelerating in the U.S. stock market, and people finally getting it, is good for gold. But this is a little bit of long liquidation. I mean, gold's been one of the best performing major assets this year. It was outperformed by copper, but we know what's happening to copper. It's going down. So just some liquidation. I think it'll stabilize and eventually head to 4,000. The key thing is if the U.S. stock markets drop into S&P 500 towards 4,000, which I think that's good for gold to head towards 4,000. But again, that's very much significantly deflationary.
In a surprising move that rattled global markets, U.S. President Donald Trump announced a sweeping new set of tariffs, dubbed Liberation Day tariffs, imposing a 10% baseline import tax on all trading partners. The announcement sent shockwaves through financial markets, triggering a sharp decline in the U.S. dollar and reigniting demand for safe haven assets, particularly gold. Amid this volatility, gold has continued to demonstrate resilience. MikeMcGlone, senior commodity strategist at Bloomberg Intelligence, maintains that gold has solid support around the $3,000 level and is unlikely to fall much below it. He views the current dip as temporary and expects the precious metal to eventually move toward $4,000, particularly as deflationary forces gain momentum and the U.S. stock market shows signs of weakening. Gold's performance in 2025 has already been exceptional, having surged to new all-time highs above $3,000 in the first quarter alone. In response to the evolving macroeconomic landscape, HSBC has revised its gold price forecast, raising the average price projections for 2025 to $3,015 and $2,915, significantly higher than previous estimates. Investment sentiment is shifting in favor of gold, driven by strong demand for gold-backed exchange-traded funds, ETFs. Analysts at Heraeus report significant inflows, particularly with ETFs adding approximately 23 tons of gold on March 21st, marking the most important single-day increase since 2022. In the first quarter of 2025, gold ETFs experienced net inflows of approximately 152 tons, marking the highest holdings since September 2023. While gold attracts both institutional and retail interest, silver has lagged despite outperforming gold due to weaker industrial demand and recession fears. Institutional investors are increasingly reallocating capital to gold, indicating confidence in its long-term stability. McGlone points to rising long-term U.S. Treasury bond prices as a classic indicator of a deflationary environment, one in which gold historically thrives. After years of outflows, gold ETFs are experiencing a resurgence in demand, marking a notable shift in investor behavior. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
So gold has been stretched from managed money net positions for quite a while. A lot of those things have been lightened up and going in ETFs. So this is just a little liquidation. I think gold is first supports around 3,000. I don't think it stays much below that. The paradigm shift that's happening in the market of just a little bit more deflation finally accelerating in the U.S. stock market, and people finally getting it, is good for gold. But this is a little bit of long liquidation. I mean, gold's been one of the best performing major assets this year. It was outperformed by copper, but we know what's happening to copper. It's going down. So just some liquidation. I think it'll stabilize and eventually head to 4,000. The key thing is if the U.S. stock markets drop into S&P 500 towards 4,000, which I think that's good for gold to head towards 4,000. But again, that's very much significantly deflationary. And on the year right now, that U.S. Treasury long bond, like TLT, is up about 7%. Yeah, 6 to 7%. Bitcoin's down 12%. S&P 500 is down 7%. That's deflation just getting started. The point is it's so overdue. So still bullish gold. Pretty good support around $3,000. It might tick below that a little bit, but I think I'm pretty sure these trends that we really accelerated today are going to continue. That's just deflating risk assets. Means from here on, a long duration like a 30-year zero coupon bond might outperform gold. Sell what you can in golds. If anybody's been long, gold's got a lot of profits there they can sell. They've already started selling Bitcoin. There was a lot of profits there. Started selling that well before. But I think that's a key thing to remember. I want to rope that in there because to me, what's happening in gold is what's most significant to mention. And we've had almost about 4 years of significant outflows in gold ETFs. That's flipped now. They've just shot up this year, completely tilted around. Investors are getting it. Like, yeah, I need some store value. I'm done. The S&P 500 was on a tear. Yields were higher. Volatility was low. That was always a pressure factor in gold. That's switching. So investors are flipping towards gold. They're getting it. We've already seen the central bank buying. So I'm still quite bullish gold. I think this is just a blip in the trend. But what happens sometimes is you need one day to flip the narrative. And I think everybody gets it now. Risk assets, most notably risk assets, are for sale on rallies. Yes, that means they're going to be sharp short covering rallies. But gold, I think, is going to be bought on dips, maybe around 3,000. The key thing that really triggered me is when Bitcoin hit $100,000 on that massive frenzy. That was a signal to buy gold, sell Bitcoin. And it's very similar to me in risk assets. It was very similar to me that when the NASDAQ printed 5,000, NASDAQ Composite in 2000, right about 25 years ago. And the key thing I like to point out is gold is great. It's zero correlated. In fact, it's negative correlation. Stock market's increasing, the negative correlation increasing. Yet the correlation of Bitcoin, sometimes people call it digital gold, the stock market's increasing. We're finding out that digital gold is actually much more of a leveraged beta. It's going down at a higher volatility in the stock market. And the difference is gold has three dependents: silver, platinum, and palladium. The only reason they're really going up is because gold's going up. People need to know that silver is not going to outperform gold in an environment like this, the stock market going down. It's unlikely. But Bitcoin was the first crypto in 2009. It had a great run. Everybody loves it. Now it has millions and millions, 13 million dependents based on what the data last on CoinMarketCap.com. That's a problem. And you look at the next most significant, Ethereum looks like it's breaking down below 2,000. I just see that as we increase volatility in the stock market, as we take the stock market out, we're finding the cryptos, most of these, which are still silly expensive, are going to maybe lose a couple zeros of value, like stock market, like a lot of .coms did, and gold should continue to appreciate.
MikeMcGlone of Bloomberg Intelligence warns that the U.S. is experiencing a significant wave of deflation, despite traditional inflation measures not yet reflecting it. While some goods may see isolated price increases due to supply issues or tariffs, the overall trend is deflationary. The sharp decline in U.S. stock market capitalization, which has erased trillions in value, indicates deflation far beyond minor consumer price rises. At the same time, the Trump administration's sweeping new tariffs are beginning to reshape the economic landscape. Federal Reserve Chair Jerome Powell acknowledged that the tariffs will likely stoke inflation while simultaneously slowing growth, a combination that complicates the Fed's policy outlook. Powell's recent comments suggest that the central bank is likely to maintain its benchmark interest rate at around 4.3% in the near term. He emphasized that while the inflationary pressures from tariffs are being closely watched, the overall economic picture remains too uncertain for any immediate action. While Powell remains cautious, Wall Street investors now expect up to 5 interest rate cuts this year, a notable increase since the new tariffs were announced. This gap between Fed communication and market expectations highlights the uncertainty surrounding the potential economic fallout from the tariffs. Powell also mentioned that businesses are hesitant and are delaying new investments until there is more clarity on policies, adding to deflationary pressures alongside shrinking equity markets and weakening global demand. Let's get back to the interview.
Let's just make it clear, it's massively deflationary, because you look at the nuances of maybe, it's a couple goods and services, just goods mostly, picks up the total trade balance in this country, imbalance is $1 trillion about. So let's say you add 20% on that, maybe that's through 200 to $300 billion. Let's do the math. So far this year, the market capitalization of the stock market has dropped almost about $5 trillion. That's many X's of what the kind of inflation you might get from good. That's the most significant deflationary forces. The deflating U.S. stock market. I'm saying, and from a market cap to GDP basis, it's the highest in 100 years, and it's just reverting now. So if we give back, we've already given back about half of last year's $12 trillion. That's deflation just getting started. So it might not show up in the numbers right away, but it's showing up in the bond market, and they get it. 4.04 in that U.S. Treasury note, which, by the way, is still over 230 basis points above what we see in China, 1.72. And I just have to remind people, I traded Japanese government bonds in 1995, and I've seen this before. Deflation on a global basis is accelerating. China is really pressuring it lower, and once that U.S. stock market goes down, it's kind of 1930s type deflation, just getting started. But it's normal. The book Price of Time by Edward Chance Professor just pointed out, we always get deflation after inflation, most notably when we pump liquidity. And also, I just love that book by Jeff Booth, The Price of Tomorrow, pointing out the deflationary forces of rapidly advancing technology. Just look at all this rapid technology that's being exported out of China, and the U.S. has to put imports tariffs on it to prevent, the collapsing our U.S. the automakers, because they make better cars and are much cheaper. So one thing about copper, I'll just state my facts. I think it's minimum going down to 4. That's essentially almost where it's trading in London now, and if you convert to a U.S. dollar price. But part of the reason, the number one reason copper is going to go down is because it went up. It's just the way copper works. Last year's high was $5.20. That was really driven by U.S. futures. It got way too extended long, and the low came around 4. It's doing the same thing now, and that is, as an ex-trader, I look at copper as, I know where I probably would have been stopped out trying to short it, but once it made that high a couple weeks ago, about 537, that to me was a red light leaning. We just squeeze as many shorts as possible. We're going to do what it normally does and go back down. The key fact for copper is it was just the major disparity in spread on anticipation of U.S. tariffs on imported copper. It made that spread between U.S. traded copper and London copper reach almost 20%, the greatest ever, and futures going back to 1997. So that put in a good, blow off top. Now the risk is it goes back to 4 and maybe even lower. Because what is bullish about Dr. Copper, the metal that known to have a PhD in economics, from the rest of the world facing tariffs from the world's most powerful, significant demand pull source that's been waiting to do these kind of things for decades. I mean, so to me, this is that was a decent blow off top. And the key thing I learned in commodities trading is you got to hurt the most people first before you go in the direction it really belongs. So I think copper minimum is going to go down to 4. I think it's good resistance around 5, and then we'll see if it gets really serious. It's got to stay above 5 to show something really bullish, which I think is unlikely. I think the risks are, like crude oil dipping to $40 a barrel, the risks are that copper goes back below $4 a pound. Now, this is looking ahead. The key thing about copper, though, is if U.S. stock market goes down, that's a huge headwind for copper.
No. As financial conditions weaken, gold has become a key beneficiary of shifting investor sentiment. With global trade measures and signs of a downturn on the rise, capital is returning to safe havens. The decline in equity valuations, cautious corporate investment, and signals from the bond market highlight a brewing economic reset. Gold's rise reflects not just inflation fears, but deeper concerns about stagnation and long-term financial instability. Is gold's strength signaling the early stages of a deeper economic recalibration, and could it redefine portfolio strategies in a deflation-prone world? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.